What a glucose crash area.
Ooh, it says live in the upper right-hand corner.
Oh. Yeah, dude. Okay.
Jay's mic's
We don't sign up early. Mexico.
Well, good afternoon, ladies and gentlemen. My name is Mark Mayers with the Jesus Film Project here in Southern California. I just wanted to give you a 10-minute warning. We'll be starting our webinar in just 10 short minutes. Thank you for logging on. We'll see you in 10 minutes. Hello, ladies and gentlemen. Mark Mayers from the Jesus Film Project office here in Southern California. Hey, just a little heads up, 5 minutes from now we're going to start our webinar. Thanks for logging on. Just 5 minutes from now we're going to start the webinar. Thank you so much. Well, good afternoon or evening, depending on where you are, ladies and gentlemen. On behalf of the Wycliffe Foundation and the Jesus Film Project, welcome and thank you for joining our fifth in our series of webinars on topics of gift and estate design. My name is Mark Mayers, and I serve as a regional representative in Fund Development Office of the Jesus Film Project here in Southern California. I also work in Phoenix as well. I'll serve as your moderator and host during our webinar this afternoon. Perhaps some of you who are watching today have taken part in one of our previous webinars. Well, welcome back. Today's session is entitled Appreciated Assets, Your Key to Leveraging Tax Dollars for Greater Kingdom Impact. By the way, if you missed any of our previous 4 webinars, the recordings of that content are available at the link on the bottom of your screen there. The presentation today comes to you through a joint partnership of the Wycliffe Foundation and Jesus Film Project, which of course is a ministry of Campus Crusade for Christ. Wycliffe and Jesus Film have worked together for many years in the area of language translation, but now we're teaming up in serving our friends and financial partners of both of our organizations in the area of gift and estate design. By the way, also joining us today on our webinar are different ministries of Campus Crusade, like Athletes in Action and the International School Project. Other Wycliffe ministries, such as the Seed Company, JARS, and the Graduate Institute of Linguistics, are also logged on for the webinar this afternoon or evening. Through the power of web technology, our presenters are going to share with you essential concepts that can help you preserve your estate, provide more for those you love, and advance the ministries and organizations they care about most. A number of past webinar participants have already taken advantage of this opportunity. Effective stewardship has been executed. Lives have been changed as a direct result of these webinars. So thanks for logging on. I think you're going to benefit highly from this time together. During our webinar, you'll no doubt have questions for our experts. We'll answer those questions at the end of their presentations, which should be right around 30 minutes, 25 to 30 minutes. During the session, you may submit your questions at that time, any time during the broadcast at that chat box at the bottom right corner of your screen. If after our time together you'd like to share this presentation with others, or if for some reason you need to take off early today, a recording of this content will be available at the same web address beginning October 6th. Also, the slides that are going to be presented today will be available at that link just below the little box where you can type your question. So you can see that, the blue link down there in the bottom right-hand corner of your screen. Our presenters are here with me in Laguna Niguel, Southern California today. Let me introduce our gift and estate design experts. Michael Acapeni is from Monument, Colorado. Michael's worked in the gift and estate design arena for over 27 years with organizations like us, Campus Crusade, and the Salvation Army. He's currently a gift planning advisor with the Wycliffe Foundation, which is, one of the ministries of the Wycliffe Bible Translator family of ministries. Michael studied business and economics at UCLA and holds a master's degree in taxation from USC. Who does that, Michael? Welcome to the webinar, by the way.
Well, thank you, Mark, and welcome to our viewers. We look forward to the time we'll spend with you today.
I think long about April, everybody's hoping they had a master's in taxation, so they could figure things out as well. Jay Link is from the suburbs of Grand Rapids, Michigan, and he's also joining us here at Jesus Film headquarters in Southern California. Jay has served in financial and philanthropic leadership roles for a Fortune 1000 company for over 30 years. Since joining Crew as a gift and estate planning consultant, Jay has used his expertise in accounting and in charitable giving to help ministry partners become more effective stewards of the resources God has entrusted to them. Jay holds an MBA and earned the professional designations of Certified Public Accountant, Certified Management Accountant, and Certified Gift Planning Associate. How many certified? Are you certified in SCUBA also, Jay? Welcome to this webinar.
Thank you, Mark. It's great to be here.
Yes, we have master's degrees abounding, certifications abounding, and we are here to serve you today. Both Jay and Michael have served hundreds of ministry partners for many years, helping them leverage their current giving as well as their deferred giving after their homegoing. So if your goal is to be the most effective, efficient steward you can be, you're in the right place. Without further introduction, let me turn this presentation over to Jay. Jay?
Well, it's great to be here today. And you know, one of the things that when we think about the whole topic of appreciated assets, it's really part of a much bigger topic, and that is biblical stewardship. And when we think of biblical stewardship, the thing that comes to mind is, you know, what exactly is a steward? I mean, as stewards, we are entrusted with the things that God's given us, and He expects to use us to use those assets for good purposes. But how do we define a stewardship, a steward? Well, a steward, a definition that I have come across that I think is a great definition of this, is it's one who uses God-given abilities to manage God-owned properties to accomplish God-directed results. When we think of the whole notion of biblical stewardship, there's three underlying principles that I think are important for us to emphasize. The first one is that God is the owner of all. Now, we have things that have been placed at our disposal and things that He wants us to use, but He really owns them, and He's entrusted them to us for us to use for good purposes. Number two is the whole notion that planning, or gift and estate planning to be specific, is a spiritual process. So while today we'll talk about mortality tables and interest rates and tax rates and a variety of technical and legal things, at its core, gift and estate planning is a spiritual process. And then the third principle is that we want to be able to make sure that we're using the gifts that God has given us, both intangible and tangible gifts, for His glory and honor. So those are three key principles that we want to keep in mind as we think about biblical stewardship. So then that begs the question, how can you be a more effective and tax-wise steward? If you look at the next slide, this will cover the things that we're going to talk about during our webinar today. First of all, we're going to talk about how you can make capital gains taxes optional. Then we're going to spend a little bit of time talking about how you can multiply or leverage the impact of your giving through appreciated assets. Next, we're going to talk about the whole notion of trading tax dollars for kingdom dollars to increase your charitable impact and build your legacy. As we think about tax dollars, we're going to show you ways that you can either minimize or eliminate them, and then you have the opportunity to use those for kingdom purposes. And lastly, we are going to look at a number of case studies of those who have used some of these tax-wise strategies in a successful way. Michael, I will turn it over to you.
Thank you, Jay, and again, welcome to all our folks watching today and tonight. As Jay mentioned, one of the first things we need to cover is what I call there's bad news and there's good news, kind of like the road to salvation. You have the bad news. We faced lots of taxes, and essentially, in particular, as we talk about gifts and appreciated assets, they present some additional tax challenges that we'd like to talk about. So as you look at this slide here, you'll see we all face taxes, and depending on your level of income and what state you live in, it can be from 0 to over 50%. And then there's a federal capital gain tax when you sell an asset that has appreciated. There's also a state capital gain tax. The national average is about 5%, but again, it all depends in what state of the country you live. And of course, then there's the Affordable Care Act, which is a new tax, the Obamacare tax, some people call it. Again, so as you can see, you're facing a whole gamut of tax that comes to the discussion about appreciated assets. And in particular, if you want to compare what you will do, selling the asset versus utilizing some shareable strategies to avoid all of these taxes. I love this quote from a very well-written, very quotable judge in our judicial system in the 1900s. Judge Learned Hand said, "Anyone may arrange his affairs so that his taxes shall be as low as possible. He's not bound to choose a pattern which best pays the Treasury, and there's not even a patriotic duty to increase one's taxes." Over and over again, the courts have said there's nothing sinister in arranging your affairs to keep taxes as low as possible. Everyone does it, rich and poor, alike, and all do right where nobody owns any public duty to pay more than law demands. To demand more in the name of morals is mere cant. And we're going to talk about that today. How you can arrange your affairs and with the wealth that God has entrusted you to lower your taxes. And as Jay alluded to transfer those tax dollars to kingdom dollars. We like to tell folks, they kind of surprised me state, did you know that capital gain tax is optional? What do you mean? Taxes have to be paid. Well, let's look at it. With the capital gain tax, there's 3 options. You can pay the tax, and depending on the state you live in, that can be upwards of 40%. Right, the case here for folks living in California. You can postpone the taxes. And typically folks will do that through something called a 1031 exchange or maybe an installment thing to spread them out. And you can bypass or avoid the taxes. Now, under our tax system, there are only 2 ways to avoid capital gain taxes. The first way is death. Probably not the preferred option for most people this time. The second way is charitable gifting. And through charitable gifting strategies, as we'll show you today, you can transfer those dollars you can't keep anyways because you have paid in the taxes, but if you can give all or a portion of those to charity and causes you believe in, wouldn't that be a better option? So that's essentially what we're going to talk about today. I'm going to pass back over to Jay.
Thank you, Michael. If you look at this next slide, you'll see some of the benefits of gifting appreciated assets. First of all, you heard Michael talk about the various different level of taxes that we have, both federal and state, and income and capital gains. And by gifting appreciated assets, you're able to avoid those multiple levels of taxes. And so there's significant savings that accrue to you because of that. Secondly, we're able to help you be able to give more substantially from assets versus cash flow. You know, there's an interesting statistic out there in stewardship circles, and that statistic says that most people that give out of 9% of their assets or their wealth. And that would be mostly their liquid assets or their income stream. But the other 91% of their assets or wealth, which are illiquid, most folks don't know what to do with that when it comes to giving. So we help explore ways to turn those non-liquid assets into cash flow that can be used for kingdom purposes. And then lastly, again, as Michael had talked about just previously, we help you to think through how you can either minimize or even totally avoid tax dollars. And then you have the option to use those tax dollars to further kingdoms, to further ministries that you have passion for. What type of assets do we want to think about when we look at appreciated assets? Well, there's at least 4 categories. We'll talk about several of these in a little bit more detail today. The first one is what we would call securities, and that would be stock or mutual funds that you hold. The second category would be real estate, and that could be rental property, it could be land, it could be commercial business property that you hold in a business. The third one would be business interest, and perhaps you are a business owner and you have an interest in a C corporation or an S corporation or an LLC or a limited partnership. And there are ways that you can take that business interest, which has appreciated in value, and use that for kingdom purposes as well. And then the last one, which we at least want to mention, but we won't talk about in detail today, and that's the whole notion of artwork or collectibles. And when we think about collectibles, we think about things like jewelry, precious metals, things of that nature. So we want to look at some examples today of how we can look at some of the things that people have done to utilize these tax-wise strategies in a successful way. And I'm going to turn this back to Michael as he shares with you a couple of case studies that he's been quite familiar with.
Thanks, Jay. And as you might note in that slide there, these case studies are for illustrative purposes. They illustrate the point. Of course, your rates and assets may differ. Okay, we said the disclaimer. Now let's move on to the case studies. The first one we'll look at is just the idea of an outright gift of an appreciated asset versus a cash gift. We call that quintuple tax savings. That's not a ward of the maternity ward of the hospital. That's actually what we're talking about. You have many layers of tax savings from a gift of an appreciated asset when compared to a cash contribution. And to best illustrate this, we're going to show you this brief case study. We have a couple, Rachel and Nick there. They decided they have an asset worth $10,000 and they paid $4,000 for it. and they're quite a substantial tax bracket, 40%. Now, if they were to make a gift of cash, let's say a favorite charity, they would get a deduction for the $10,000, and at their tax bracket is saving approximately $4,000. But if they instead gifted an appreciated asset, they would get the same tax deduction, but the net tax results would be significantly higher. And let's show you why that is. As you look at the next slide, you'll see when a person makes a gift and appreciated asset, the first thing is the law allows you, if you've held it more than 12 months, it allows you to deduct it at its full fair market value. So, as with the normal cash gift, they're going to get their federal tax savings and their state tax savings, which is about $4,000, but there's more. Under the tax law, if you give a gift of an appreciated asset, you avoid the capital gain taxes. And both on the federal level, 20%, and on the state level, 5%. And there's this thing called the Obamacare tax, the Affordable Care Health Tax. And if you add those all up, we're talking tax savings of over $5,000 compared to a $4,000 deduction and a tax savings for a cash gift. And if you put that in a percentage, we're talking 43% increase in the tax benefits from gifting an appreciated asset. And oh, by the way, they still have that $10,000 in a checking account that they can do with the Lord leads them to do. So as a baseline, we wanted to show you this idea of an outright gift. An appreciated asset most times is a much better tax-wise gift versus a cash asset. Let's take this a step further now, the next case study. You may say, that's really great, Michael. Jay, I like the idea of an appreciated asset, but I want to give more than one charity. How can I do that? And certain assets, the example we're going to look at here, real estate, that's kind of difficult to do. And this is actually based on a case we worked with a couple up in the Seattle area last year. Don and Joe owned real estate. That's all they do. They acquired many real estate properties over the years. And they thought, we want to make a contribution with these properties to our church and to other charities, ministries they had in mind. But how do you do that? They knew if they sold the property and gave the cash, in their case, they're facing a 30% capital gain tax rate. So the question we had was, well, how can we accomplish our goals with an asset like real estate? Well, our solution was, let's set up a donor advised fund, and I'll explain in a moment what that is. But the idea was, it's like their own little private foundation, only it's better. They established this fund, they called the donor advised fund, and contributed that asset into the fund. That gave them the tax deduction at the full fair market value, and they avoid the capital gain taxes. So you saw that previous slide, they get all the tax benefits. Once the property was sold and it was cashed out of that fund, then they were able to make grants to the church and to their favorite ministries. And so they were able to use this tool to make a significant gift to more than one charity by putting it in this thing called a donor advised fund, so they could spread it out amongst the different charities. Really quickly, how a donor advised fund works, and that's another webinar we did a couple of times ago. Basically, a fund is set up with a charity that sponsors a donor advised fund, and they're many out there. I know that both the Great Commission Foundation Crusade has one, as does Wycliffe. But it's a very simple 1- or 2-page application. The fund is set up. The asset is gifted into the donor advised fund. In the case of the Creeds, it was a real estate, which we had to sell. But once the cash was there, then the Greens get to make grants to favorite charities, just like a private foundation. They make grants to several charities that they favor. And so, very simple setup. But again, here's the idea of making a gift of a significant appreciated asset, avoiding the capital gain taxes, and allow them to further benefit supporting more than one charity. Moving on to one more case study, then I'll hand it back over to Jay. Some people say, well, that's really good too, but I don't want to give away the whole asset. I want to keep some for myself for whatever needs they may need, retirement, personal needs. And sometimes when that's the case, we look at something called a gifted sale, or sometimes I call it a zero tax gifted sale, and I'll show you why I mean that. I use that phrase. But again, here's a case study, again, a real-life couple, names been changed, protect the innocent, so to speak. Kirk and Cindy owned farmland, which they inherited from his parents. The parents had a basis they purchased over the years. It was a $100,000 basis. As many of you know, especially you folks who are watching in the areas where there's farmland has appreciated quite a bit. And now it's worth over $500,000. And it's a good piece of land. They've had many offers to sell the land over the years because they live about 1,500 miles away. They really don't manage it. But they thought, yeah, that'd be great, but wow, it comes at a high cost. And the high cost is capital gain taxes of $120,000. So they understand, if we sell it, we can't keep all of it, but boy, we really don't want to pay that kind of tax bill. What can we do? What can we do that would allow us to sell it? And as Jay referred to in one of the early slides, instead of paying that money to the tax treasury, transfer that to Kingdom. So this next slide shows you, again, before we got to the gift and sale, just kind of gives you a basis. The outright sale, $120,000 loss of capital, and that just didn't sit well with them. It didn't sit well with me. So what we suggested instead was, let's do this. And both Jay and I have the software to run this. If we could give enough to charity and allow you to keep enough, we can get a zero tax effect. Let me show you how. We determined that if they gifted, in this case, $210,000 interest and undivided interest in the land to charity, and they kept about a $290,000 interest, now the land has two owners, and together we sell the property together. Well, what happens? Well, on the part which they sell, they have a capital gain tax liability of about $59,000. But on the part that they gifted to charity, that also creates a charitable deduction, which in their tax bracket will save them about $69,000. And as you can see, what we do, we use the tax savings of the gift portion, offset the capital gain taxes, and essentially we come up with what we call the zero tax solution. So what have they accomplished? They have sold a portion of land and really gotten $290,000 tax-free. And they've gifted a portion of the work of the kingdom of over $210,000. They are happy. And so, just to summarize what I've covered so far, we can go from an outright gift of the entire asset to one charity to possibly using a donor advised fund to spread out that gift to multiple charities, to a case like this where they kept part of it and gifted part of it, got the zero tax effect, and still provide a significant gift to the work of the kingdom. Now I'm going to pass back over to Jay, who's going to show you some other tax planning strategies worth considering. Jay?
Thank you, Michael. Those are great illustrations. In fact, I'm going to build on those a little bit as I talk about a couple of illustrations myself. And the first one is the use of a charitable remainder trust. A charitable remainder trust is a specifically designed trust that, from a tax perspective, affords some special benefits to the donor. So here we have a situation, John and Melinda, they're both 66, and they've recently retired. They've always enjoyed giving to kingdom causes, and they would like to receive some additional income in their retirement over and above what they're going to get from Social Security and their pension. 20 years ago, they purchased some property in a publicly held company that at the time cost $50,000. Recently, the dividends on this stock have become quite small, and so they're concerned that they're not going to be able to get the income that additional income that they want for retirement from this stock. So they're thinking about selling it, and its current market value is about $200,000. So the question that we would have before John and Melinda is there a way that they can utilize the stock that they hold to generate additional income during their retirement and avoid capital gains taxes and also help their favorite ministry? And yes, I believe there is, if they transfer the stock into a charitable remainder trust. So let's look at a flow chart that will describe how this will happen. If you look at the left-hand side of the chart, you'll see a rectangle there that shows the property that they have, which is the stock that's valued at $200,000 and has a cost basis of $50,000. If they transfer that stock into what we would call a 5% unit trust, which is another term for a charitable remainder trust, when they do that, they achieve two benefits. First of all, they're able to bypass the tax and the capital gain, and secondly, they're also able to receive an income tax deduction on the fair market value of the property that they transfer into the trust. Now that deduction generates some tax savings for them. But once the stock is transferred into the trust, then the trustee of the unit trust will then sell that and invest the cash in a diversified portfolio. And out of that portfolio, then they will receive 5% per year of that value to them as a couple over their remaining life. So that equates to about $10,000 a year for the next 25 years, or almost $250,000 during their retirement. So you can see it's a significant amount of security for them. But the final benefit of this kind of arrangement is if you look at the right-hand rectangle, that if that trust is able to earn at least an amount equal to that which it pays out, then the value that's invested in that trust will remain intact. And at the end of the trust, that amount is available to a charity of their choice, and it will pass without going through probate. So you can see a number of benefits that this vehicle affords this couple. Let's look at another example. And this is a charitable remainder trust and sale. Now this is very similar to what Michael went through with us when he was talking about the gift and sale or the zero tax transfer. Only this time, as opposed to going directly to the charity, goes to a charitable remainder trust. So here we have Don and Dolores. 20 years ago, they purchased some wooded acres in the northern part of Michigan that at the time was worth $30,000. And their goal was to keep that land, thinking that when they retired, on that land they would build a cottage and spend some time there with their children and grandchildren. In recent years, however, their 3 children and their families have moved to warmer southern states, so building a cottage in northern Michigan no longer makes a lot of sense. So they're considering selling the land for $150,000, using the cash to buy an RV to travel to visit with their family, and then take the balance and invest it for their retirement. So the question that we would have for Don and Dolores is there a way that they can sell the land, avoid capital gains taxes, generate some cash for current purposes and for the future, and yet also help their favorite ministry? And yes, I think they can do that by employing a charitable remainder trust where they would transfer a portion or a percentage into the trust. They would retain a portion themselves, and then they would have the land be sold. So let's look at the flow chart on this transaction. At the left-hand side of the flow chart, again, you see the value of the property. In this case, it's the land. That's valued at $150,000 at the cost of $30,000 for a gain of $120,000. So they would take a portion of that $150,000 value of the land, and they would retitle that or transfer that into a 5% unit trust. And they would also keep a portion of that land titled to themselves. So it then has 2 different owners themselves in the charitable remainder trust. Now when they do that, keep in mind that they get the benefits that we talked about in the previous example of when something gets transferred into a charitable remainder trust, they avoid having to pay the capital gains taxes on the capital gain, but they also get an income tax deduction which generates some cash savings for them. Now, keep in mind, they've kept a portion of that land in their own name. So when the sale takes place, on the portion that they've retained, they will have some tax liability due on it. But if the deal is structured appropriately, the savings that they get from what they transfer into the trust from a cash perspective will offset the taxes that they pay on the portion that they've retained. So it'll end up being a zero tax transfer, similar to what Michael has talked about before. But we also have another benefit that, again, once the amount is transferred into the trust and the property is sold, that amount is invested in a diversified portfolio. And out of that portfolio, they will receive 5% a year over their remaining life. So in their situation, it's about $4,200 a year over the next 21 years for a total of $91,000 during their retirement. And then we can also see, again, to the right, a final benefit that they get from this kind of structure, and that is that if they're able to earn at least the amount on what's in the trust, on what's paid out of the trust, then the value of the trust will remain intact. And at the end of the charitable remainder trust life, that amount can pass to a charity of their choice without having to go through probate. So again, you can see this strategy accomplishes a number of objectives for this couple and can be extremely useful in helping many people achieve the objectives they want for retirement and for charitable giving. Let's look at one more example, and this one is particularly interesting to understand if you are a person that owns your own business, because this is one that will turn a portion of your business into cash that you can then use for kingdom purposes. And this is called the Charitable Equity Partnership. Let's look at this individual, Joe Jordan. He owns a successful real estate development business. And because of his passion for spreading the gospel, he has used his business to give as much as he could to ministry, but he still wants to do more. Joe learned about the whole notion of a charitable equity partnership, which allowed him to release a portion of his business, accelerate tax deductions, increase cash flow back to himself. It could be used to either reinvest in the business or it could be used for personal expenditures, but then also free up money for ministry. So how does that work? Well, as a business owner, Joe decided to donate a minority non-voting interest in his business to the Great Commission Foundation Trust. When he did that, he received a tax deduction and the corresponding tax savings that went with that tax deduction. That share that was then transferred into the trust earns profit as a portion of his business, and it's taxed, but it's taxed at no more than half of Joe's individual rate. So you can see some real tax advantages to Joe as a business owner by doing this. And then that after-tax profit, as well as whatever gain he gets when those shares are sold, because in the future Joe's going to sell the business, the portion that he's retained outside the trust and the portion that's in the trust. And when that happens, that capital gain will go into a donor-advised fund. And then he can advise on that fund to the ministries that he wants to make grants of his own choosing. So let's look at the flow chart as to how this works. We see here Joe, he's taken a portion of his business. We don't know whether it's a C corporation, an S corporation, could be an LLC, could be a limited partnership. This works for any of those kinds of entities. But he takes a portion of that, he transfers it into the Great Commission Foundation Trust. When he does that, he gets a deduction which generates a cash flow of cash savings back to him, which he can choose to reinvest back into the business, or he can use that for his own personal expenditures. On that portion that's retained in the trust, the portion of his business, that will generate profit, obviously, as the business is profitable, and he'll pay taxes on that portion. And then that net profit gets transferred into a donor-advised fund, as well as the eventual sale of that portion of the business. Also, that capital gain will get transferred into the donor-advised fund. So that at the end of this scenario, he has a donor-advised fund where he can advise which charities he wants to see that money go to. So you can see we have a vehicle here that's taken a portion of his business, generated some significant cash flow for his own personal purposes, for reinvestment in the business, and also for kingdom purposes. So it's a very powerful tool in the hands of a business owner. And I'm going to turn this back to Michael.
Thank you, Jay. I trust, we both trust, you can see if you've done some of these short case studies, the power and the versatility and the flexibility of using asset-based planning in your giving and philanthropy and stewardship. And there's a great quote here by a famous Greek fellow named Aristotle. You may have heard of him. He said, "To give away money is an easy matter and in any man's power, but to decide to whom to give it, how large and when, and for what purpose and how is neither in every man's power nor is it an easy matter. Hence, it is that such excellence is rare, praiseworthy, and noble." Why do we put that out there? Well, I think I can speak for Jay and I. Some of the greatest pleasure and joy we get working with our ministry partners is to show them how they can accomplish their philanthropic giving through different charitable strategies. And as an exercise is, how can we help you? Well, our service is designed to you, our partners, our donors. It's a ministry to you. And if we can serve you in this way and show you how you can do better stewardship and tax planning, everyone gets. And when we meet with people, of course, it's all confidential. And there's never any cost or obligation to give. Jay and I, we do not sell products. We are not commission, salary kind of guys. We work with your advisors as needed. And as important, we understand, like us, you also probably have multiple charitable interests. You probably support your church and Wycliffe and Crusade and a number of different worthy causes. We get that. Our job is to sit down and listen with you and help decide, okay, based on what you tell us you want to do and why, then we can show you the how. How to invest through the best tax-wise through it. And really, it's up to the Holy Spirit's job to direct what charities and ministries you want to support. So that's how we can help you. And Jay's going to tell us how we fit into your overall team and planning team.
We realize that most of you probably already have a team of professional advisors that surround you and act as a kind of a security of counselors around the decisions that you have to make. You may have an attorney, you probably have a CPA, you probably have an insurance professional, perhaps a financial advisor or a financial planner. We think all of them are important. They bring a special set of skills and competencies that are needed to advise you. But we want to be a part of that team because we think we bring some special perspective as well, and particularly from a charitable perspective. And so when we are part of your team, we guarantee that you will not experience any pressure. As Michael had said so well before, there's no cost. We do this as a way of saying thank you to our ministry partners for them being involved with our ministries. And there's no hidden agenda. We don't talk about where to give or how much. It's simply to help you to become better at how you give. We're your friends. We've been a part of this ministry for a while, and you know and trust us, and therefore you can rely upon us giving you good, sound advice. We'll also make sure that you understand all of your options so that you can then make clear, competent, thorough choices. And lastly, but probably most important of all, we will help you reap the benefits of being wise stewards of that which God has entrusted for you to use.
Wow, guys, I am just so thrilled. Again, I think this is my 5th webinar with you all, and I just learned so much. Michael and Jay, thank you so much for your insightful thoughts and your presentation. Well, now is the time, ladies and gentlemen, for Q&A. So keep using that little box at the lower right-hand corner of the screen on your computer. And but first, I'd like to share with our audience that as a representative of the Jesus Film to our donors, I personally have felt compelled to engage with the Great Commission Foundation regarding my gift in estate design. So my bride, Leslie, and I are right in the middle of our own complimentary and confidential estate inventory with Jay. We are so looking forward to Jay's advice as Leslie and I seek to leverage our position as stewards. Ours isn't a large estate, but one thing I do know for sure is that we're stewards over 100% of it, as you are. Also, having worked with donors for more than 18 years now in Southern California and the Arizona area, I have seen firsthand tens of millions of dollars mobilized for kingdom building simply by introducing donors to our colleagues over at the Great Commission Foundation and the Wycliffe Foundation. I am so glad there's men and women who have God-given expertise in gift and estate design like Michael and Jay. I hope you are too. So thank you guys once again for your expertise in this area. Well, in light of this still groggy economy and our newer higher tax rates combined with this presentation, I'm sure there's plenty of questions out there in our audience. Once again, ladies and gentlemen, use that little box down there. We'll take as many as we possibly can to write down your questions. Okay, and we'll take those as they come to us. Okay, so our first question is a reminder. This is actually a reminder, actually a question from a while ago. People are absolutely going to ask this question, so I'm going to ask it for you right now. The question is the IRA rollover giving option available for 2014? Who wants to take that one?
I'll take it.
Michael.
Jake can obviously add to it. Yeah, that's a great question. If I knew, I'd be rich, I guess. But it's been discussed. It's actually been passed by the Congress on the side of the House, but that's as far as it's gone. We hope that Congress will extend that law, unify your IRA, And hopefully after November, I guess, when the elections are done, that'll be the case. I wish I had a crystal ball, other than to say we're hopeful that that'll happen. But your guess is as good as mine, Mark.
Okay. Anything to add, Jay?
No, I think Michael captured that well.
Okay, good. All right, question. Ready for this? I have already. This is a question from our viewing audience. I've already received and accepted an offer for the sale of some land I've been holding for several years, but I've not closed on the transaction. Can I transfer that land to a charitable remainder trust and reap the benefits that you described in your example?
I'm happy to take that one, Mark. And that's a good question, because a lot of folks are pretty far down the path with certain transactions, and they want to know if they're able to reap some of the benefits of some of the things that we talked about. You need to be careful. If you've entered into, if you've received an offer and you've accepted it on particular real estate, and then you want to reap the benefits of transferring that all portion of that into the charity or the community trust. It could be difficult for you to be able to make that work on the IRS. And they would consider that a during sale if you're not completed down the road. If you've got a buyer in the wings and nothing's signed, that clearly is okay. And there's some gray matter in between, clearly. But we would certainly say that if you entered into some kind of a written document accepting an offer, probably would not be something you would be able to benefits of it.
Gotcha. Yeah. Anything to add, Michael?
No, I think Jay covered it quite well.
Got it. Okay. Good. One of the most fun things that I don't know if I told you this. One of the guys I call on is a former builder. He's built whole subdivisions, been in real estate development his whole career. Well, he keeps buying homes and sticking them in the Great Commission Foundation, and on Fridays I get to go out and help him work. This is called sweat equity. He's on his 25th home right now. We're ready to do another transaction as we speak. So if you have some homes out there you want to flip over to the Jesus Film or the Wick Foundation, please don't hesitate. I have some rental property. This is question number 2, fellas. I have some rental property that I'm considering gifting to ministry. How do I determine the market value of this property so I can obtain the appropriate amount of donation for income tax purposes?
Excellent question. When it comes to assets such as real estate or business interests, but let's talk about real estate because that's what the question was referring to, you need an appraisal. The tax law says if it's worth more than $5,000, you want to take a charitable deduction, you need to get an appraisal from a qualified appraiser who deals with that type of real estate to set the value for tax purposes. And so there are realtors for there are appraisers for residential property. I was just in the Dakotas talking to a person doing an appraisal for farmland. Different types of property, different types of specialists. But the key is getting qualified appraisal because that's what your tax deduction is based upon. That's what perhaps you look at a charitable trust that Jay discussed. That's going to set the value first year at least. So that's critical. Again, it has to be over $5,000. If we're talking stocks and bonds, that can look that up in the Wall Street Journal. There's an active market or something like that. But real estate, you need a qualified appraisal to take the deduction.
And I might add to that, Michael, that it might be good to work with your CPA on that because there are a lot of very specific guidelines that the appraisers must meet as far as education, experience, years in the field, that would allow them to be either qualified or not qualified as an appraiser. So you don't want to go through that process and find that you have someone doing good work that doesn't meet the IRS guidelines. Then your CPA should be able to give you clear guidance.
Gotcha. Hey, I have a friend who is interested in possibly selling his boat. Would that be a different kind of appraisal? I mean, what would you recommend? It's not a real estate appraisal guy, is it?
Well, Michael, what is it for that?
Jay and I looking at each other, what? Boat? Now, typically a boat, unless that gentleman is living on it as a primary residence, the couple, it's simply considered personal property. So that's you really don't have an appreciation per se there. I would more often not advise that gentleman to sell the boat give the cash. But if you decided to want to take the deduction, you could do it. But there probably need to be an appraisal done, and I believe the tax deduction is the lesser of the appraised value of what his cost basis is. So that's more personal property type of gift, not really an appreciated asset. I don't know how many boats appreciate, but that's my answer, Jay. Anything for you?
No, I think
put a lot of money into mine.
Yeah, I think it's a good point. I think that boats tend to be somewhat like cars. Their value, although it may appreciate, it could very well depreciate. So there might not be really any advantage in going to using that asset or using it.
Gotcha. Well, you know, one of the things that I am really excited about you two guys is I talk to donors all day long, and they ask me these questions, and so I'm glad I have you guys to go around and answer those questions. Hey, I got another question here. Are there any minimum dollar amounts or ages that exist to set up a donor advisement, or what you guys are calling a DAF, D-A-F?
Well, I'll jump in on that one, and I think probably Michael and I have a very similar perspective on these. Within the Great Commission Foundation, we welcome donor advised funds, and the only stipulation that we would have from an amount perspective is we want the minimum investment, whether it's cash or whether it's an appreciated asset, to be at least $5,000. And we also would have a requirement that at least 10% of the amount that's given from the donor advised fund would go to support a food ministry, and then the other 90% could be used for ministries of your choice. We also encourage, and I want to make sure that you do this, that we encourage people that have families to engage in donor advised funds, because it's a great way, if you've got children, who you want to teach them how you give and understand the values that you have around your giving. You can bring them into this decision-making process of deciding where the money should go from the donor advised fund, and they can be a part of that and learn how you do it. So you're really passing on that value to the next legacy. So it's a great tool to teach giving to the next generation.
Mm-hmm.
Yeah, I think I would just agree 100% with what Jay said, and I think we did a previous webinar on this topic, and I think Mark referred to a link we can look at that. But I agree 100% with what Jay said. I think the only thing else I would add and I think Crew and Wycliffe are the same, 10% to 390 to others. We also say it is a donor advised fund. You're advising us to give. We would never grant, and I don't think anyone in our audience would ask us to make a grant to an organization that's antithetical to our Christian faith and beliefs and values. But other than that, they're a wonderful tool for people to employ.
Well, without even knowing it, you answered the next question that came in. So thank you very much for that. It's just, do you always send it to the person or the organization that they ask you to? You wouldn't if it were an organization that was antithetical to the mission vision, either Wycliffe or Campus Crusade. So, wow, you saw that one, huh? Wow, how about you? You know, the donor advised fund, guys, it feels like, and my own personal little foundation is it's sort of analogous to that without all the administrative hassle that private foundations have.
Clearly,
Yes, definitely.
yeah, clearly.
Okay.
It's a great tool without having to handle the administrative, legal, financial bureaucracy and traditions.
Okay, yeah, so if I'm out talking to donors and they're thinking about, you know, they just had some big windfall, or they sold a company and they want to found their own foundation, we could actually become that for them within either organization.
Yes. The only correction to your statement, Mark, is you want to have them before the windfall, before they sell the appreciated asset, talk to Jay or myself, because it's too late, they sell it. So
There's tax advantage ways to do
we always like to tell folks, before you sell, call, because it's an appreciated asset, which is the theme of our webinar. That person can avoid the capital gain tax and then put it in the donor advised fund. So what you said is true.
Okay.
The timing.
Good point, though. Yeah, the timing is call us before you make any transactions. Don't call me. All right, let's going to shift gears here, guys. Next question. If I want to do the gift or sale or the CRT and sale, how do I know what portion to gift or transfer to the CRT and what portion to retain? Does that make sense?
Well, Jay, since you covered that one, you
I'm
can
happy.
answer that one
That's
there.
a great question. there's an algorithm in software that we have access to that we can load in the variables so we know the fair market value and the basis of the appreciated asset. We also have your tax bracket. We can load that information into the software. It will tell us how much to retain for the owner versus how much to retitle into either the charity or the CRT, so that the net effect is that it's a zero tax transaction. So we can actually calculate that spread.
I would add one thing to Jay's answer as well. I think Jay and I talked about this over lunch the other day. We talked about that it is an offset. Capital gain taxes are offset by the charitable deduction. Sometimes we also, and that's where, again, get the accountant involved, sometimes the offsets may happen yearly, sometimes they happen over 1 to 6 years, depending on the person's adjusted gross income. And so it's a caveat I'd like to put in there, but essentially you get a zero tax effect if not in 1 year, over 2 or 3 years.
This is so helpful. Gosh, I call on another guy. This is just so helpful. Thank you. Just for the listening audience, I call on this other guy. He's got a business partner, and he's got 8 partners in this partnership that owns the business partner outright. And so the guy I call on is charitably intended. 7 of the other ones want to buy another property to spin off income for them, and one guy wants cash out. And so this year, the Great Commission Foundation and others are talking to the partners about dissolving the partnership, doing this 1031 thing you guys talk about, exchanging into a like-valued property, and then the one guy's going to have a tax event. But all I needed to know, ladies and gentlemen, in watching and listening to a lot of that, all I needed to know is please call my friends at the Great Commission Foundation and the major donor reps for Wycliffe. You just need to know, call Michael, and he's going to work this all out for you. Good idea?
Good idea.
Good idea. All right, help me understand. I'm going to shift gears one more time. I don't know if this is helpful for the audience when I throw things out there about the people that I actually call on, because you are the people that I actually call on. Shift gears. Another question. Help me understand again why I need your services in addition to all my advisors I have in my life. Don't my CPA, don't my attorney, my financial advisor, don't they know all these things?
Let me respond to that, because I thought a little bit about that in my bullet points there in the presentation. But let me expand on that a little bit. You know, there's verse in the Book of Proverbs that says there's security in multi-bank accounts. And so we think it's important that any person who's charitably minded and wants to be a good steward in that assets surround themselves with as many advisors as they can to help inform their process and their decisions. Now, we realize that obviously people have to have attorneys. They're probably going to have some PAs and insurance professionals and financial advisors and founders. And we would encourage you to make sure that those individuals are people of faith, that they are believers, so that they can share your values as you interact with them around these very important decisions. But we have found that when we are added to the mix, and we bring you the charitable perspective that you need, and the biblical stewardship perspective that you need for the work that we do, that we are always able to add value to the decisions that you as a steward are able to make. And so that's why we want to be part of the mix. We want the synergy that we can experience by working with the other team members, and we just think that the more people that are around the table, the more successful your decision will be.
Yeah, I would just add, I think Jay really hit on the head. And a lot of people say, attorneys, for example, they don't practice this like Jay and I do every day. If you go to law school, I got an advanced degree in tax law. I mean, we didn't even talk about charitable tax planning that much, even when I got that degree. So it's something that Jay and I do day to day, and so we add that element, as Jay referred to, and many times they don't think about that and the possibilities that charitable planning can involve helping their clients accomplish their mission.
I remember I was on an appointment one time with a man in a rural area, and he was getting ready to make a transaction, and he wanted to have, it wasn't Jay, it was one of Jay's colleagues over at the Great Commission Foundation. He wanted some more information from his attorney and his CPA. Well, Jay's colleague, his name is Barry, literally called the CPA while we're sitting there at this guy's kitchen table and got the answer to the question, called the attorney, got the answer to the question, and now we were able to move forward with helping the team. This is a team approach in making this transaction, so this guy could make a tax-advantaged stewardship decision, which really is, I mean, in my view, it was worship. It was beautiful to watch these men, they happen to all three be men, making this decision on a real-time basis at this man's kitchen table. And I just got to go, wow, that was so cool.
You know, Mark, the thought that comes to my mind when you hear that is the word that I mentioned. There's synergy. There's ways that we can help them, and there's clearly ways that they can help us. They have certain competencies and skills that we might not have as well. So, as a team, we can be a powerful force in the life of a living school.
Yeah, yeah. And just to reiterate, I mean, these guys have nothing to gain. There's nothing to gain but just the satisfaction that they're helping the team make a great decision. All right, guys, let's switch gears again. We have another question here. We have about 3 minutes left on our answers, so we're going to make this a lickety-split question. Your examples, this is from a viewer, your examples perk the interest of my wife and me on a number of fronts. If I provide you information to our situation, can you prepare an analysis that shows how these strategies would play out for us?
Well, yeah, for sure. I mean, that's what we do. We when Jay and I do our work, and if we do it well, we need that information. We probably want to sit down and talk to you and tell us more. What is it you want to accomplish and why? And then looking at the information about your assets or the composition of your estate. And that's something I like to say, and I think Jay would agree, is we try not to do this in a vacuum. We try to do this in the context of your overall wealth and financial planning and estate planning situation. So, to talk to you, what do you want to accomplish, why? Then with that and with the data you can share with us, which is confidential, then we can come back and make some recommendations, 1 or 2 or 3, depending on how that conversation goes.
And if you share with us the information, we can actually do a little financial analysis or scenario that will put it in very concrete terms what your situation looks like. It would be very similar to some of the examples that we shared today. So you can make concrete decisions.
Yeah, and I'll tell you how confidential it is. Being a donor rep, when I ask someone like Jay, "Oh, what's happening with so-and-so?" he says, "Can't say." It's confidential. So, Michael and Jay, we are just so thankful for you guys. What a treat to have your presentation and the answers to these questions today. It's like having another advisor in the living room, literally, for many of our viewers. It's my understanding that our guests will contact either or both of you at any time to ask questions directly by 3 a.m. when we say anytime. Michael and Jay are ready to help you in any way so you can consider your appreciated assets as a key to leveraging tax dollars for greater kingdom impact, as the title of our webinar has suggested. Remember, a video of this recording of this presentation will be available after October the 6th, as well as the slides. You can download the slides from this presentation if you'd like to take those to any or all of your advisors. Again, after Monday, October the 6th. Please feel free to share this video with family and friends, and just in case you want to watch live again and see my pretty face, Saturday morning, 10 o'clock Pacific time. I already know of several people who are going to log on. 10:30 Pacific time. What is that? 1:30 West or East Coast time. So if you want to watch live again, and maybe some other questions will come up. Hey, if this presentation has been beneficial to you, will you please let us know? Your feedback is very, very helpful to us in producing future webinars. Okay, we're planning another one next spring, right before Tax Day, for our masters in taxation over there. Just before April 15th, we're going to have a similar topic related to gift and estate design. So please stay tuned. Thank you so much again for logging into this webinar today. God bless your day. Good night.